Financial Accounting, Chapter 9, Long-Term Assets, Part 3 of 3. So up to now, we've talked a lot about what the transaction is going to look like to record the depreciation expense on a fixed asset. Remember, depreciation expense is defined as the allocation of an asset's cost over its estimated useful life. We went through two methods for calculating depreciation expense: straight line and the production method. We also talked about the accumulated depreciation account as a contra asset, because we use this account because the asset itself is not worth less than we originally paid for it. Instead, we're just showing how we've allocated the asset's cost over the life that we presume this asset's going to be useful in the business to help us earn revenue. Again, this is all part of the matching principle. So in this part 3, we're going to be talking about asset disposition. And if it's no longer useful and has no residual value, it's worthless, in other words, it's discarded. And if this is the case and you have an asset on the books, on the accounting records as they call it, then you just remove the accumulated depreciation and the asset itself. So we're going to start with a really simple basic example, and then we'll move to something a little more difficult in this section of asset disposition. So as our illustration, assume that some equipment that costs $25,000 has been fully depreciated, and that means that the $25,000 equipment that's fully depreciated has accumulated depreciation in the contra account of $25,000 as well. So if it is discarded, the equipment is removed from, of course, the premises, and on February 14th in this example, they write off the discarded equipment by crediting the equipment to remove it and debiting accumulated depreciation. The records for this piece of equipment are no longer there. So let me pause a minute. If you're genuinely following this, stop and think. This is the first time we've introduced an example where there is no residual or salvage value, but that's part of helping us to understand. So if the asset has not been fully depreciated and you're getting ready to discard this asset, then you have to update depreciation before removing the asset from the accounting records. Remember these adjusting journal entries that we're doing. We're assuming an accounting period. So if you're removing a fixed asset before the end of the accounting period, maybe the accounting period is 12 months and you're removing it 3 months into the accounting period, then you have to update for depreciation expense because you did actually use that piece of equipment for 3 months, and that depreciation expense is recording the cost of that asset to offset or match the revenue earned during that period. And this is different from the gain or loss on the disposition of this asset. So we've got an example of equipment of $6,000, again, no residual value, and it's a straight line depreciation of 10%. That's probably assuming a 10-year life, of course. So $6,000, $600 a year is the estimate for straight line depreciation. It has $4,650 on December 31st. You should be thinking, okay, it looks like they bought this part way through the year. And let me pause a minute before I continue with this problem. What this is reminding us is that companies don't buy equipment on January 1st and sell or discard or dispose of it on December 31st. We have to deal with partial years. So let's continue. On March 24th, which is almost the end of March, of the following year, the asset's removed and discarded. In other words, they don't sell it for anything, they just get rid of it. So the entry to record the depreciation for the 3 months before the asset is discarded is as follows. You take the $600 per year times 3/12, that's January, February, and March out of 12 months in the year, and you first update depreciation expense. So note that the new accumulated depreciation, that's what the that's what the ACC stands for, accumulated. The new accumulated depreciation is the $4,650 plus the $150. So we've updated accumulated depreciation. Now we need to record discarding of the asset. So we remove the $6,000 asset by crediting an asset, that's for its removal, and we debit accumulated depreciation on the equipment, which is a debit because this is normally a credit balance. So if we're going to remove it, we're going to debit. And then we're going to record something called loss on disposition of equipment or loss on disposal. And that's because it's the difference between the cost of the equipment and the amount of depreciation we have accumulated. In other words, this $1,200 is the book value, and that's the amount that we lost by disposing of this piece of equipment. Now, this loss is going to be reported on the income statement. It's different from depreciation expense because it's showing that we lost money when we disposed of the asset. So if you recall from us talking about income statements in prior chapters, we talked about other revenue and expenses. This is going to be one. So let me give you a real-world example. Several years ago, Budweiser, Anheuser-Busch, owned the Cardinals, the St. Louis Cardinals, and there was a record showing the disposal of the asset of around $16 million. It was a gain, and it was shown in other revenue and expenses. Many companies have this type of stuff to delineate between the normal operations of a company and other types of revenue and expenses that can incur within a company. So now let's talk about genuinely selling, not discarding or disposing of. We'll go through several examples. And the most important key to this is remembering book value. So as I had talked about in prior parts, you need to have a few definitions memorized in Chapter 9. One of those definitions is how to calculate book value, and that is taking an asset's cost minus its accumulated depreciation. So if we were in a face-to-face class, I would give this example, and I guess the best I can do is verbally, because I don't have a board to write on right now. If an asset has a book value of $1,000 and it's sold for $1,000, there is no gain or loss. If an asset has a book value of $1,000 and it's sold for $1,200, there's a gain of $200. If an asset has a book value of $1,000 and it's sold for $500, then there's a loss of $500. We're going to see that as we go through this example. One of the things that we will do is match the selling price with the book value, and if it's greater, there's a gain. If it's less, there is a loss. So again, we're going to be comparing cash to book value. So this is very similar to the prior examples, but now we've got to deal with cash, debiting cash that we receive from selling our equipment. So let's assume we've got $10,000 piece of equipment with no residual value and a straight line depreciation of 10% sold for cash in its 8th year of use, when the accumulated depreciation is $7,000. So now we've got $10,000 here with $7,000 worth of accumulated depreciation. You should be thinking, first of all, well, on December 31st, it had a book value of $7,000, but it looks like we continued into the 8th year and we sold it on October the 12th. So first, we have to update for 9 months. So you should be asking yourself, why 9 months? That's because January through the end of September. We don't have a half a month or more, so we're going to go January through September. We're going to update for 9 months of depreciation expense on this asset that currently has a book value of $3,000, but it's going to have less once we update this depreciation expense. And let me throw in this comment. If you're having trouble following, I would suggest you go back and listen to some of the other videos and possibly try some of the problems within the text, or maybe study it through the text. So first, let's update depreciation expense, and that is we've got this $10,000 times 9/12 at 10%, and that's $750. Our normal depreciation expense has been $1,000 a year. Now it's $750 because we have 9/12 of a year. So if we are going to record the disposition, the sale of this asset, we first update the depreciation expense, which now means, of course, that our accumulated depreciation is not $7,000, it's $7,750, and that's going to record a decline in the book value. 10,000 minus 7,750 is 2,250. This is now the book value of this asset. So to continue with this problem, all we need to do now is compare the amount of cash we receive with the book value. If we receive no cash, then we lose $22.50. If we receive more than $22.50, we have a gain. Less than $22.50, we have a loss. So if we sell it at book value and say, hey, I'm going to sell this asset regardless of what it is. Lots of times companies will have a car and they will sell them to their employees at book value. If this were a $10,000 automobile sold at book value, then we note that we take the equipment or the car off the books, and we also take off the accumulated depreciation. We record the cash, and there's no gain or loss. If we sell the asset for $1,000, then our loss is less because the book value is $22.50. We record the cash and we remove the cost of the asset and its accumulated depreciation, and we record a loss on sale. If we record a gain, that would mean that we sold it for more than $22.50, and in this case the cash that came in was $2,800 compared to our book value, which was $22.50, and that means we have a gain. Let me show you something that should be evident to you. Notice that the gain on sale of disposition is a credit because it's a type of revenue, and revenue is increased by a credit. The same for losses. Losses are like an expense and they are a debit. So note my tip. On SitLearn, there's a very helpful video that might help you with recording the gain or loss on asset disposition. Let's move now to natural resources. These are things such as timber, minerals, oil, and we're going to be recording, instead of depreciation, we're going to be recording something called depletion. Depletion expense is recorded on a natural resource. And it's determined as follows. Take the cost divided by the estimated total units of the resource, and then you'll just take this depletion rate and multiply it times the quantity removed. So let's take an example of a company that purchases mining rights, and they pay $4,000. They estimate they're going to get 1,000,000 tons. So we're going to take this $4,000 divided by 1,000,000 tons and find that that comes out to be 40 cents a ton through the formula. And that 40 cents per ton that we've calculated here will be multiplied times the 90,000 tons for the current year that were extracted, and we will record depletion expense of $36,000. And the adjusting entry to record this depletion is to debit depletion expense and credit another contra account called accumulated depletion. Again, because these are estimates, because this natural resource may have more or less than 1,000,000 tons. Now, what do you do if it's more or less? That's something that you will discuss in an advanced accounting course, probably an intermediate. Intermediate's the course that follows financial accounting for accounting majors. Let's move to intangible assets. These are long-term assets that don't physically exist. And patents, copyrights, trademarks, goodwills, they may be acquired or purchased. So let's say that a pharmaceutical company purchases the formula for manufacturing a cancer-curing drug, or let's say that the copyright to music is purchased, or a specific trademark is bought, or let's say that a company pays more for a business than the assets are worth. That's going to generate goodwill. That's what these intangibles are. So patents are exclusive rights. Copyrights are exclusive rights to use a musical or artistic type of work. Trademarks are just actually what you are familiar with, and we'll talk about goodwill in a minute. I've got a full definition page coming up. Intangible assets are calculated through a decline in the value called amortization. A lot of people have trouble with that term, amortization. And amortization is a result of just the passage of time. Because copyrights are for a certain period of time, or a patent is for a certain period of time, and it shows that that time is expiring. And that's the amount of cost to transfer to an expense, because intangible assets are also considered assets. So here's an example. A patent is an exclusive right to benefit from an innovation. A copyright is a literary, artistic, or musical composition. A trademark is a name, term, or symbol. And goodwill is the excess of the purchase price of a business over what you pay for it. It's an example may be a dental practice where goodwill is frequently used. Let's say that a dentist buys another dentist's practice and pays not only for the equipment within the practice, but also the goodwill and name of the dentist that had owned the practice. He might have to pay an excess amount, and that's considered to be goodwill. And the amortization period is listed here, and the expense is shown here. It's a little bit beyond the scope of the course that we're studying right now. The most important concepts are examples of intangible assets and the fact that for the most part they're subject to amortization expense. Finally, financial reporting for long-term assets is shown here just for a wrap-up. Let's see what it would look like on a balance sheet, and that is that under the plant, property, and equipment section and the intangible section, we have land, which you've already talked about is not depreciated. And this one we have buildings and their accumulated depreciation. Here's the book value as of December 31st in this year. We have office equipment subject to accumulated depreciation. Here is the book value. And here's our total PP&E book value. Remember that this is the balance sheet, so this is showing us the assets estimated book value, which is taking the historic cost minus an estimated cost allocation to show that this building and this office equipment was used in the company to help them earn money. And finally, we have a patent down here that we've listed as an intangible asset. And yes, this is extremely frequent in use. You always hear in the news one company buying another company, somebody buying YouTube or buying Yahoo. And these types of acquisitions frequently will include patents or trademarks or goodwill. So I hope that this helps with Chapter 9. Remember the discussion, remember the homework assignments and the quizzes, and please let me know if there's anything I can help you with.